Imagine reading a company's financial report and seeing a clean bill of health from the auditors, but a month later, the company collapses. How could that happen? That's where audit reports and their limits come in. I think the German company Wirecard is a good example of how their auditors E&Y did not properly verify cash balances of $2 billion and were ultimately banned from auditing public companies in Germany for 2 years. Wirecard filed for bankruptcy, and the scandal led to criminal charges, multiple civil and criminal proceedings, and the collapse of its share price and market value, which of course means significant losses for investors. In this video, we'll review the history and content of audit reports, the differences of audit opinions, and reports between the AICPA and PCAOB, and the limitations of audit reports. The history of audit reports is closely tied to the development of modern accounting practices and the need for financial transparency and accountability. The Industrial Revolution in the 18th and 19th century led to the rapid growth of corporations. With more complex financial structures, the need for independent oversight of financial statements became apparent. However, formal audit reports were still not common at this stage. The late 19th century saw the emergence of independent auditing firms such as PricewaterhouseCoopers and Ernst & Young, which provided audit services to businesses. These firms helped establish the profession of auditors, and since 1926, the New York Stock Exchange has required an auditor's report. The early 20th century brought significant changes to audit reporting. In the United States, the creation of the Securities and Exchange Commission, SEC, in 1934, as a response to the Great Depression, introduced more rigorous financial reporting and disclosure requirements for publicly traded companies. The Securities Exchange Act of 1934 requires all public companies to have an independent auditor's report in annual financial statements. Professional accounting organizations such as the American Institute of Certified Public Accountants, AICPA, developed auditing standards to guide auditors in their work. These standards provided a framework for conducting audits and reporting on their findings. The early 21st century marked a significant milestone in audit reporting with the enactment of the Sarbanes-Oxley Act in 2002 in the United States. SOX mandated stricter oversight of corporate financial reporting and introduced requirements for auditors to assess and report on internal control over financial reporting, ICFR. This had a major impact on audit reporting practices. Whereas PCAOB guides the audits of public companies, the AICPA Auditing Standards Board, ASB, oversees the audits of non-public companies. Today, independent auditors express or disclaim an opinion on whether an entity's financial statements and related disclosures are presented in accordance with GAAP. There are several differences between the AICPA and PCAOB audit reports. The standard that guides non-public companies under the AICPA is Exhibit 5.3, Unmodified Opinion for Non-Public Companies. The standard that guides public companies under PCAOB is Exhibit 5.4, Unqualified Report, including critical audit matters. The AICPA's audit report is titled Report on the Audit of the Financial Statements, whereas the audit reports for public companies are titled Report of Independent Registered Audit Firm. Critical audit matters are required under PCAOB, but not under AICPA. In terms of management's and auditors' responsibilities, the AICPA requires detailed descriptions, but PCAOB has less detailed description requirements. Non-public companies use GAAS or Generally Accepted Auditing Standards, but public companies use the standards of PCAOB. The non-public audit report under the AICPA has references considering internal control and design of audit procedures, not informing an opinion, whereas the PCAOB audit report has a separate additional paragraph for internal controls over financial reporting. PCAOB AS 1301, also known as Communications with Audit Committees, is a standard issued by the PCAOB. This standard outlines the requirements for auditors to communicate with the audit committee of a company's board of directors during the audit process. The primary purpose of PCAOB AS 1301 is to establish clear guidelines for effective communication between auditors and the audit committee. This standard ensures that important information regarding the audit process and the company's financial statements is shared, enabling the audit committee to fulfill its oversight responsibilities. The standard specifies when and how auditors should communicate with the audit committee. This includes communication both before and after the audit engagement. Auditors are required to communicate significant audit findings to the audit committee. This includes matters related to accounting policies and practices, financial statement presentation, and any issues that could affect the company's financial reporting. Auditors must discuss critical accounting estimates and significant unusual transactions with the audit committee. If there are unadjusted misstatements identified during the audit, auditors must communicate these to the audit committee and discuss their potential impact. The standard also requires auditors to obtain written representations from management regarding various matters. And these representations are to be discussed with the audit committee, and auditors must communicate their independence to the audit committee and discuss any relationships or services that could potentially impair their independence. Auditors are required to provide a formal written communication to the audit committee, typically in the form of an audit completion letter. This letter summarizes the audit scope, significant findings, quality of the company's financial reporting, issues discussed, and any other matters relevant to the audit, such as disagreements with management and significant difficulties encountered during the audit. It serves as a formal record of the communication between the auditors and the audit committee. PCAOB AS 1301 is important because it enhances oversight, transparency, and risk management. The new PCAOB audit standard PCAOB AS 3101 went into effect for audits of fiscal years ending on or after December 15, 2017. Except for the requirements related to critical audit matters CAMS, which is effective for audits of fiscal years ending on or after June 30th, 2019 or later. In determining whether a matter to be disclosed involved especially challenging, subjective, or complex auditor judgment, the auditor should consider the following factors: the auditor's assessment of the risks of material misstatement, including significant risks, the degree of auditor judgment related to areas in the financial statements that involve the application of significant judgment or estimation by management, including estimates with significant measurement uncertainty, the nature and timing of significant unusual transactions, and the extent of audit effort and judgment related to these transactions. The degree of auditor subjectivity in applying audit procedures to address the matter or in evaluating the results of those procedures. The nature and extent of audit efforts required to address the matter, including the extent of specialized skills or knowledge needed, or the nature of consultations outside the engagement team regarding the matter. and the nature of audit evidence obtained regarding the matter. The auditor must communicate in the auditor's report CAMs or state that none were determined to exist. However, the PCAOB has expressed that they expect at least one CAM will be identified in each audit. Deloitte's accelerated filer analysis found an average of 1.8 and found CAMs related to goodwill, intangible assets, revenue, and income taxes. An unmodified or unqualified audit opinion is the best possible outcome an auditor can provide after conducting an audit of a company's financial statements. It's often referred to as a clean opinion. An unmodified or unqualified audit opinion indicates that the financial statements of a company are presented fairly and in accordance with the applicable accounting standards or generally accepted accounting principles, GAAP. An auditor should give an unmodified or unqualified opinion when the financial statements present fairly financial position, results of operations, and cash flows. That means that there are no material misstatements. The company complied with accounting standards and demonstrated consistency and transparency. The opinion is usually presented in a standard form and may include specific wording such as, in our opinion, the financial statements present fairly in all material respects the financial position of the company as of a date, and the results of its operations and its cash flows for the year then ended in accordance with fill in applicable accounting standards or GAAP. Certain situations may call for adding an additional paragraph, either an emphasis of matter or other matter paragraph as defined by AUC 706. Modified or qualified audit opinions are types of audit opinions that auditors issue when they encounter certain issues or limitations during the audit process that prevent them from providing an unmodified or unqualified opinion. These opinions indicate that there are problems with the company's financial statements or audit process that require explanation. And a qualified audit opinion is issued when the auditor believes that, except for one or more specific issues, the financial statements are fairly presented in accordance with the applicable accounting standards or generally accepted accounting principles. The qualification is made when the auditor encounters a specific issue that has a material impact on the financial statements. This issue could be related to accounting methods, financial statement presentation, internal controls, or the availability of audit evidence. A common example of a qualified opinion is when a company's financial statements include a particular accounting treatment that the auditor disagrees with, but the rest of the financial statements are considered accurate. An adverse audit opinion is the most severe form of modification. It is issued when the auditor believes that the financial statements do not present fairly in accordance with the applicable accounting standards or GAAP. An adverse opinion is issued when the auditor identifies material misstatements in the financial statements that are so significant that they cannot be corrected or explained. These misstatements are considered pervasive and affect the overall accuracy of the financial statements. In the auditor's report, the adverse opinion is clearly stated, and the auditor explains the nature and extent of the material misstatements that led to this opinion. An adverse opinion might be issued if the auditor discovers evidence of widespread financial fraud or significant errors that fundamentally undermine the reliability of the financial statements. Modified or qualified audit opinions are significant because they signal to users of the financial statements that there are issues or limitations that impact the accuracy or reliability of the financial information. Stakeholders, including investors and creditors, may approach the company's financial health with caution when a qualification or adverse opinion is issued. Both the disclaimer of opinion and withdrawal from an audit engagement are unusual occurrences and are generally seen as unfavorable outcomes for all parties involved. They signal significant issues or challenges in the audit process that require attention and resolution. Companies and auditors should work together to address these issues promptly and transparently to ensure the integrity of financial reporting. A disclaimer of opinion or withdrawal from an audit engagement occurs when an auditor is unable to issue an audit opinion on a company's financial statements. These situations are relatively rare, but may happen for various reasons. This can happen when there is a significant lack of information, severe limitations imposed by the client, or when the auditor encounters substantial uncertainties that prevent them from forming an opinion. It can also occur when the auditor is unable to obtain sufficient audit evidence due to factors beyond their control. A disclaimer of opinion is a significant concern for investors, creditors, and other stakeholders because it indicates a lack of confidence in the financial statements. It suggests that there may be serious problems with the company's accounting records or that the auditor was unable to gather enough information to make a judgment. Withdrawal from an audit engagement occurs when an auditor decides to terminate the audit engagement before completing the audit. This can happen due to various reasons, including a breakdown in the auditor-client relationship, ethical concerns, trust issues, or a lack of cooperation from the client. Common reasons for withdrawal include discovering fraud or unethical behavior within the client organization, a loss of independence, the client's failure to provide necessary information or access to records, or a fundamental disagreement between the auditor and the client. When an auditor withdraws from an engagement, it is a significant event that can have serious implications for the client, especially if the client is a publicly traded company. The client may need to find a new auditor and address the issues that led to the withdrawal. Withdrawal triggers the filing of the SEC's 8K form by management. While audit reports play an important role in providing assurance about the accuracy and reliability of a company's financial statements, it's important to understand their limitations. Auditors are responsible for conducting audits based on established auditing standards, but there are inherent constraints and boundaries to what an audit can achieve. Remember, an audit is powerful, but it's not a crystal ball. Auditors work with samples, estimates, and limited time. It's assurance, not a guarantee. So let's go over the key limitations in terms of audit engagements. First, there are limitations related to evidence and scope. Auditors don't test everything. They work with samples, rely on controls, and can only look at past information. In terms of time and resources, audits are bound by deadlines and resource constraints, and independence can be blurred if auditors also provide other services. Next is judgment and estimation. Much of auditing rests on professional judgment, deciding what's material and how to evaluate complex or uncertain transactions. And finally, fraud and going concerns. Highlight that audits are not designed to catch all fraud and cannot predict the company's long-term survival with certainty. It's essential for financial statement users to be aware of these limitations and not solely rely on the audit report. Auditors provide reasonable assurance, not absolute certainty, about the accuracy of financial statements. Therefore, users should complement audit reports with their own due diligence and analysis when making investments, lending, or other financial decisions. Additionally, open and transparent communication between auditors and clients is crucial to address and mitigate some of these limitations. In the AICPA audit report, these limitations are communicated via 3 important phrases in the report: reasonable assurance, material, and presented fairly. As I already mentioned, audit reports are powerful tools. They build trust in our financial system. But like any tool, they have limits. As future accountants, your job is not just to understand the words on the page, but to know what they mean and what they don't.